on when we can expect to see long bonds, the dollar, and the euro each move in directions we've been predicting for a quad 4 macro environment. If the recent action is just a short-term pop, how much more pain do you think we should expect to tolerate?
Well, you know, you have to incur some pain if you ever want to accomplish anything. Again, if the data were to change, I would change. I don't change because I have some pain. I mean, if I get run over in a hockey game, do I change my skates? No. I mean, I get up and do what I do. You know, the pain is part of the game. Okay, we can go through this a lot of different times. Please, for the next 30 minutes, if you want me to, you know, apologize or something for that, it's not going to happen. Okay, I don't apologize for the process or how we play the game or when we get scored against. I get up and I do my job. Okay, so that's what we're going to do. If anything that changed, you know, the reason why I got into or started to get into treasury bonds and utilities for that matter, I would let you know. Okay, so it's not my job to lose for protracted periods of time. And again, we're staying with, this is a kind of, I know it's hard for a lot of people, and I'm definitely not trying to underestimate whatever pain you might have if you lost 1% in something like utilities or something like that. I know there's a lot worse that could happen, and I have and will have it happen, and you will be part of that, and you'll blame me, and I hope you do because I'm accountable to it. But again, if we go through the path here and you start to think about what the true pain is going to be, the true pain, the kind of pain you feel this morning, if that's the most pain you're ever going to feel, is a couple more basis points in the 10-year yield. Okay, even if that's the most pain you've ever felt, I can empathize with that. I get it, especially if you're going big on it. I get it. I totally understand it. But imagine the pain. Imagine the pain if you started capitulating on shorting EM, China, Europe at the beginning of the year, because there's many times where those trades went the other way. These things were all careening to the upside when we started making those calls. So I'm always willing to take some pain for that longer term gain. And that's what I'm willing to do. There's nothing in the data that has changed other than what I said. By the way, there's quad 2 data that we told you on Friday. And I also told you on Friday that bond yields could go higher. So that's what happened. On that data, that's what they should do. So again, understand why you have pain and understand why the process is in place to give you some confidence that that's not how you're going to start to manage your money emotionally, because that's absolutely not the way to do it.
Your thoughts regarding income? Should I buy and hold the 3-year treasury?
3-year, that's interesting. Sure. I think it's more interesting to be on the long, to get long duration. So again, if you look at slide 8 in the macro playbook, you can see that getting long duration is really the place to go, duration being further out on the curve, 10, 20, 30-year bonds. So that's what I do, but if you want to buy treasuries, I'm totally cool with that either way. The problem with buying 1, 2, 3-year paper is, of course, you're still hostage to the Fed being hawkish, late cycle like they always are, and they always stay too hawkish too long. That's why the curve starts to invert. So if you look at slide 55, I think it is in the current macro deck, we'll just review where we are. And by the way, none of that's changed this morning either. Even though bond yields have moved, really the shape of the curve is still like 26, 25 basis points is the tilt on 10s minus 2s. Okay, so when you look at this chart, so again, this yield spread is 10s minus 2s. The reason why this starts to go down is because the 2s go up and the 10s start to go down faster, okay? So that's how you get that. So the Fed is effectively the 2s, or short-term rates, which is why I'm less interested in buying that, whereas this is Mr. Market saying, you know what, inflation expectations have peaked, global growth have peaked, earnings in the US have peaked. There's a triple peak. By the way, we're going to present this in full next Thursday. So for those of you that are in pain this morning, you can look forward to more conviction, I guess people have, in staying with what you're a little early on this morning. So again, what I'm expecting to happen here in the next really 3 to 6 months is for the yield curve to invert. So what happens in inversion is you go basically down here. So that would be your target in as much as it was here, here, and here. Isn't that amazing that these things are all at the same level? Yeah, because guess who gets hawkish too late at the same time? The Federal Reserve. So the Fed stops being hawkish either when you're heading towards a recession, which we're not heading towards in the US, or you have an EM or financial market crisis, which we're having right now. Okay, so there will be plenty of opportunity for the Fed to go dovish. And that's going to be something that again, there's like an 80+% chance of a rate hike in December. I expect that to be true. But the first rate hike in 2019 has fallen to like 56%, and I think that's going to fall further as we go throughout 2019.
With oil turning bullish again and yields moving to the upside, when would you change the call on inflation and yields?
That's the other thing, oil. Apologies for not mentioning the link between the two. Don't forget that oil is the #1 factor in inflation expectations. And in the last couple of days, it just went from 68 and change to 71.5. So that's definitely had impact on rates. But again, to get inflation to accelerate beyond where it's been from the peak of the cycle, go to slide 12 in the current macro deck. Right? For this not to be true, we were in Texas yesterday, so lots of talks, as you might imagine, Peeler, on oil. I live near the oil. I know. Even though 80% of people in Houston and Dallas have proven that their returns didn't know. But they know. I'm an oil man. Yep. And I'm not, all right? Okay, so I got oil guys that work with me. But anyway, moving along, our view really here, this is the main reason why you want to be getting long bonds. Again, for the last 2 years, I've not been long bonds. I'm not that jackass, okay? So at the end of the day, what I'm preparing for is this move. See this? Q4 to Q1. That's quad 4, both quadrants. Mainly, the easiest part of quad 4 is that inflation is going to fall. Now, your question probably was, I think it was, is oil up today going to change that? No, 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 no. If oil in Q4, oil would have to go above $90, and in Q1, to make that change, it would have to go above $110. $90 and $110 are a lot higher than 71.5, okay? And again, that would be one thing. The rest of the commodities complex, please again show the corn chart from this morning, is collapsing. That's agriculture. That's a big proxy for inflation expectations. Lumber's crashing, coffee prices are crashing. Plenty of problems out there. The aggregate of the commodity inflation expectation picture is the CRB index. It's going to go to like a lower high today, primarily because of oil. So things to think about. And I know, I hope this gives you a little confidence to be adding to positions in terms of the long bond position in particular when you're retesting where you could have bought a lot of bonds back in May.